Hey, welcome back to another video. This has been a highly anticipated video ever since the whole issue with prop firms and MT5 in the US. I've noticed that a lot of people have been transitioning to the futures market, which is something as similar and as effective as trading Forex or CDFs. At the end of the day, it doesn't really matter what you're trading. If you're dealing with candlesticks and candlesticks only, the strategies that you already had with Forex, indices, or CDFs will perfectly work in the futures market. It is just a different type of way of trading, since I will lay out the key factors in the differences and why these are certain things that you do need to learn. However, everything, it is very relative and fairly similar, right? So there are 7 types of futures markets. You have currencies, just like Forex, right? You have the US dollar, the CAD, Euro, GBP, JPY, etc., Aussie dollar. You have currencies, right? You also have interest rates like treasury bonds, bills, and notes. That is what actually dictates if the interest rates are going to go up or down, and other strengths that banks will have in the back end. Just as a side note, interest rate, if you do trade interest rates, they tend to have low volume. So when I used to trade futures back in 2015, 2016, I used to trade futures, and I never liked trading the interest rates because it had a very, very low volume, right? Then you also have energies like crude oil, natural gas, heating oil, etc. You also have food like sugar, coffee, orange juice. You have metals like gold, silver, copper, palladium, platinum. You also have agricultural, which is wheat, corn, soybeans. There's also more. There's rice. You can also, I remember I had buddies that used to trade, I believe it was pigs as well. So yeah, there's a lot of markets out there in regards to like free food and agricultural, right? So now, if you really think about it, why do you have all these types of futures market? Well, everything mainly started with the agricultural side of it, right? And then you also have equity, which are stock indices, which is my favorite, like the S&P, the Dow Jones, NASDAQ, and the Russell 2000. So I'll elaborate a little bit. I know that a lot of people in the CFD or the Forex side, they're familiar with the S&P, the Dow Jones, and NASDAQ. However, I'm not sure if people are familiar with the Russell 2000. And what the Russell 2000 is, are the top 2,000 penny stock companies on the market, right? So that is what that dictates. You know, NASDAQ dictates, I believe it's technology. The Dow Jones dictates the industrial companies, etc. So I just wanted to give it some clarity so we can all be on the same page. So there are 7 types of futures market. Be mindful that some of these markets have more volume than others. So you know that the equity and stock indices, they have a lot of volume, just like in CDFs, they have a lot of volume, right? Agricultural, that tends to have low volume, but during its peak hours, like the New York session, they do have decent volume and it's good to trade. Metals, of course, just like Forex, they have very, very high volume. Food, they tend to have a little bit lower volume. Energies, super high volume. Interest rates, fairly low volume, like I stated earlier. And currencies have really good volume, just like on the Forex side, right? All right, so why trade futures? Well, first of all, it is just like Forex. So to start up, it is very, very similar, right? The startup, ongoing, and transaction costs are very low for professional traders, just like with Forex. You can open an account with Forex with as little as $10 with most brokers. However, I do not recommend starting an account with $10. However, you can open an account with $10 and start trading right away. So with future brokers, it is very similar. The one that I used to use was Ninja Trader. It is still very popular now, and I know that another one that goes toe to toe with NinjaTrader is also Tradeovate, which is very, very popular, and a lot of prop firms are also using them. One thing I will mention that sometimes there are fees, monthly fees associated with trading futures. And I believe the reason for that is because it is regulated by the SEC, and also the CFTC. It is regulated by them. So there's always costs associated with things that have to be overlooked and overseen for days at a time, because they actively monitor all the trading activity that goes on a daily basis, right? And the ease of use. It is very easy to open a futures account and begin trading from anywhere in the world, just like with Forex, right? You also have leverage. With only $500 in your account, you can control over $50,000 worth of futures contracts. So I'm not saying that it's the same for every instrument that you will be trading. Remember that there are 7 types of future markets, right? But with certain markets, you will get a lot of buying power with as little as $500. However, with some of those markets in futures, you will need at least $1,000 to start trading, or you will need $900 or $1,500, and that depends on the broker that you are using and the market, right? And transparency. There is a buyer for every seller and a seller for every buyer. Trades are monitored in real time. So this is the good reason why they are regulated, because every time that you're buying, someone is actively selling those contracts, and you're buying it from them, and vice versa. It is not like with Forex that brokers can manipulate prices, and they can also have in-house liquidity. So your orders are not particularly being filled by someone. With Forex, your orders could be filled by the broker itself, which is trading against you. Why? Because the majority of traders lose money, right? So with that said, futures market will always give you a leg up, because now they're not able to manipulate prices, manipulate spreads or liquidity, or manipulate order fills, right? That is not acceptable in the futures market, and that is why the SEC and the CFTC highly monitor this market, so those things will not go overlooked, right? So that will be the regulation. I just kind of like moved ahead a little bit and spoke about that already. But the futures industry is one of the most highly regulated in the world by the SEC and CFTC. You also get a lot of tax advantages, one of them being that trading futures is taxed in the US at a lower rate than income earned by trading equities or Forex. Now, I am not a CPA, so I'm not going to speak too much about taxes. However, there are also ways for you to pay less taxes when it comes to trading Forex, of course. However, though, you do have a leg up when you trade futures, right? Volatility. Daily price action in most futures markets provide us with plenty of trading opportunities every single day. So it is similar to the Forex market or trading CFDs, like indices. They have a lot of momentum, they have a lot of volume, and you could be in and out. You can scalp the market, so you have plenty of juice and buying power or liquidity to trade it on a regular basis, right? Also liquidity. The number of trades executed each day on the most popular markets provide a buyer for every seller, similar to Forex and CFDs. So I already said that. I noticed that I'm getting a little ahead of myself with the PowerPoint. However, though, what I'm trying to show here is that it is not something to be intimidated about. You know, a lot of people say, wow, I cannot use now MT5 in the US. I live in the US. I can't use MT5, or these prop firms are not accepting US clients anymore. Now, if you really think about it, futures, it is highly available in the US, as well as futures prop firms, right? So that's the upper hand that we do have. So if you understand how to trade futures or how it works, then you know that you're 10 steps ahead of everyone else who just stays stuck with MT5 or Forex brokers. So you just want to know what you're getting into and how to manipulate it. Me, for example, I used to trade futures Like I just said, from between 2015, 2016, I used to trade futures. I loved it. I did great. However, I migrated over to Forex brokers because the leverage was even higher than in the futures market. So now if you only have 20, 30, or $40,000 in the futures market versus in the Forex market, you're gonna make a lot more money in the Forex market. And that's for sure. All right. So let's move forward. Contract expiration and rollover. Now, this is one of the slightly different things that goes on in futures, right? So, for example, I trade US 30, right? It's an index. I trade US 30. I open up my US 30 on TradingView every single day. It is always the same chart, US 30. That's it. I trade it day in and day out. Okay. When it comes to futures, there is an expiration, right, on your chart that you're opening. So the US 30 will actually have a different symbol and it will have a number because every few months it would expire and then you have to migrate over to the next chart. I know this sounds a little confusing, but as this PowerPoint unfolds, you're gonna learn more and more about it, right? So the futures market were created to allow farmers to hedge their businesses against rising and falling commodity prices between when they planted in the spring and harvested in the fall. So this is a little bit of history that I wanted to throw in here because the futures market is not just a regular market that like synthetics, something that hasn't been going on for a while. The futures market was one of the first ones ever created, even obviously before computers. This was in the time when you just see a lot of farmers in the world and they were having deals by shaking hand, and that is how they were actually making money. So I could give you an example. Let's say that I'm a farmer in the 1800s and I know that there's going to be a drought this year and I have corn, right? I sell corn. I am a farmer. There will be a drought this year. We are anticipating a drought this year. So I am not going to have a lot of corn to sell this year because we are anticipating a drought. So now supermarkets will actually pay me higher premium for my corn, supply and demand. There's not a lot of supply, so the demand is higher, right? There's not a lot of corn, so the prices increase. So now supermarkets would buy or pay me ahead of time higher prices for the corn because I'm anticipating that there's going to be a drought. And the same thing vice versa. If we see that this is going to be a plentiful year with a lot of rain and a lot of crops, supermarkets are now going to pay me less money for my corn because they know that the supply is going to be plentiful, right? So that's a good example of how to put it. I could give you another one. Let's say that, let's go more towards like the 1900s. So let's say that I own a company like FedEx or UPS, for example. Okay, and I know that I deal with a lot of gas, right, or oil because I have a lot of trucks and airplanes, and we're in the transport business. If I know that the prices of oil is going to increase in the foreseeable future, and I consume a lot of oil, I am going to purchase that ahead of time before prices increase. So as a business, I am hedging my expenses. I know that in the future, I'm going to need the oil. I need gas. I need all of that for my trucks or machinery. So I am going to buy ahead of time when it's cheaper. Also, if I know that it's going to drop in price in the foreseeable future, I can also short it. And that is the good thing about futures, that it's just like Forex or CFDs. You can go long and you can go short. So this is just one of the examples of why the futures market is here. You're always trading future prices. You're trading the price of something in the future. Also in comparison to regular US 30 versus, I believe is YM, the name of the symbol in futures. You notice that the price is going to be different. Why? Because with YM, US 30 in the futures market, you're trading future prices of the Dow Jones. While if you trade CFDs, you're trading the current price of US 30 or the Dow Jones. I hope that makes sense. If you're confused, just rewind a few more seconds of this video and it will click eventually, right? So for that reason, every futures market has an expiration date, at which point traders must begin trading the next month's contract. We'll get into that more details in the next slide. Day traders watch the volume being traded on each month's contract to alert them of when they should change contracts. And like I mentioned, there are expirations. After some months, the chart will start losing volume and you're going to have to migrate over to the next month's chart. It is not something confusing. Futures brokers have a little counter, and the little counter tells you the volume on the old month and on the new month. And once the new month gets more volume than the previous one, that's when you just migrate over to the new month's chart. It's very, very simple. It is nothing to be intimidated about, right? These are the rollover dates. For crude oil or energy, every month you'll be changing your chart every month. So on the third week of every month, you're going to start looking, I believe it's called the market analyzer. I remember that. I used to always keep the market analyzer open on my monitor because I always wanted to actively see when the next month's chart was starting to get volume and when it didn't, because it varies. It's the third week of every month, but it's never on a set date. You need to wait patiently for the volume to transition from one chart in crude oil to the next one, right? So it's every 1 month, the third week of every month. And then for metals, it's every 2 months or semi-monthly. It's the third week of February, April, June, August, October, and December. For the USD currencies or the Forex side of futures, now it is every 3 months. It is quarterly. So it's the third week of March, June, September, December. Be mindful that you don't need to remember all this data. You can easily save it or write it down. However, most people just stick to one market. Like for example, me, if I was to trade futures again, I'll be trading E-minis, which is the stock indices, right? I'll be trading either US 30. Sometimes I look at the S&P. So I will stick to the E-minis. So since I stick to the E-minis, I know that it's every 3 months or quarterly that I have to start looking for volume for the next chart, right? So you always want to keep an eye on that. And that will be the third week of March, June, September, and December, which is identical to USD currency. So it's very similar, if you notice, to the Forex market. For USD and E-minis, it's going to be USD like Forex, E-minis like CFDs. Both of those, you will be changing the chart every 3 months. They're identical when it comes to changing the contract over. So I hope that makes sense. Rollover dates. Compare the volume being traded on the current contract or month with the next contract month on the list. And that is exactly what I just explained. And I have experience with NinjaTrader. That is the only broker that I use for futures. I highly recommend it. The only thing about NinjaTrader is that I don't think they have an app, a mobile app. I don't think they have one. They are working on one. Right now it is June 2024. They might have already launched the mobile app a few weeks ago. I'm not sure. You got to double check. However, TradeOvate, they do have a mobile app. And that's why a lot of people lean more towards TradeOvate over NinjaTrader, right? And you're going to be using with NinjaTrader the instrument management and the market analyzer. Those are the two tools that you're going to be looking at to see when you have to transition from one chart to the next chart. And then roll over to the next contract month when the volume is higher on that month versus current month. We already spoke about that. You're going to slowly see volume decline as days progress on the third week of the month. You're going to see the volume decline on your current chart, and you're going to keep an eye on the market analyzer to know when to just open up the next chart and ignore the old one, right? Because it's always going to be changing, right? And you're going to be paying attention to the daily traded volume, and you're going to go ahead and change the chart that you are trading. All right, so this completes this PowerPoint. I want to make sure that I didn't leave any information out. I just want to be very clear that it is not something intimidating dealing with futures. It is something very exciting, actually. So if you ever find yourself in a situation that you can no longer use Forex brokers, because now Forex brokers are starting to not accept US clients, and also clients from a lot of other places in the world, but usually the US clients, right? Due to regulations in the US, that's how the US is. They try to make it impossible for people to trade with high leverage and to also be exposed to the market and make money. So know that if you do need to migrate to the futures market, it is pretty cool. It is pretty seamless. You're just gonna open an account with a broker. There might be a small monthly fee, like 30 or 40 bucks a month, because that gives you access to these markets. And you're just gonna have to be changing the chart every 3 months if you trade indices, for example. But everything is the same. The candlesticks are the same. The strategies that we trade are the same, or that if you trade a strategy, your own strategy is gonna be the same in the futures market. As long as you're dealing with candlesticks, you are golden. So it doesn't matter what market you trade. I could trade penny stocks again in the stock market. I don't care. As long as I'm dealing with candlesticks, I am always going to find my patterns. I might have to tweak the time frame that I'm trading, but the strategies will be there. EMAs, fibs, all that will be there and will be working. So that's nothing to worry about. If you have any questions, know that you can always slide in my DM, and fibs don't lie, and I'm always available to answer questions. And I hope that everyone thrives and make the most out of this transition. If you do make the transition, I haven't made it yet because I have no interest in trading futures. However, if I have to, due to regulations for the US, I would feel free to just trade futures, and nothing is actually going to impact my performance or my strategies whatsoever. And thanks for listening.